Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. Your weekly fix of local and international news for investors and traders alike. These are the stories that really caught my eye in the past week. Recent JSE news flow has seen a flurry of updates from retailers across both the clothing and food sectors, along with the likes of Dis-Chem and Lewis as well. Retail captures the imagination of investors because it is so tangible. You can walk around the local mall and actually see and touch the companies that you're reading about on the market. When they talk about adding new banners, a particular store format, you can actually see that playing out. You can go to the mall and see it. You can look at the number of scooters on the road and realize that Checkers must be doing something right. You can ask your friends where they shop and where they refuse to shop and draw some valuable conclusions from that as well. Overall, it is just a little bit easier to understand consumer-facing companies because we are consumers. It's a lot easier than, for example, large industrials or even the banks, really. But this doesn't make the retailers easy. It just makes them easier. The devil is always in the detail for retail. Small moves in gross margin can have a significant impact on bottom line profits, especially at retailers with structurally lower profit margins. Different retail categories have different profit margins. You do not make the same margin as a retailer from selling a lettuce that you do from selling a television or a bottle of shampoo for that matter. Generally, the rule of thumb is that discretionary or more infrequent purchases carry a higher margin for the retailer. Your daily essentials would typically be lower margin, as the retailer can rely more on throughput to achieve appealing economics for the store. Now, the direction of travel on the local market has been down this year. Many of the retailers are in the red year to date, and I wish I could quote an ETF for you on this, but unfortunately we just don't have a retail ETF on the local market, much to my irritation. However, we have seen many particularly painful moves. So Woolworths down 24% year to date, Spar down 18% year to date. Yes, there are some happier stories like value investor favorite Truworths, that's up 8% this year. But even ShopRite is in the red, down nearly 9% as the market got nervous about not just South African consumers, but South Africa in general. Now, this is a very good opportunity, of course, to lift our heads to the US market, where the supermarket businesses are having a lot more fun there than they are here. Walmart is up 26% this year. Costco up nearly 30%. It's not all smooth sailing in the retail industry, obviously. A group like Home Depot is down 4% as US consumers struggle to find the money for major DIY projects. But then again, cash build on the local market is down nearly 14%. So even the unpleasant stories in the US often seem to outperform their local equivalent. If you keep an eye on the stock indices, then this shouldn't be a huge surprise to you. If you bought a local S&P 500 feeder ETF at the start of the year, you would be up 16%. A top 40 ETF would only have returned 2.7% over the same period. Over 5 years, that S&P 500 ETF would have delivered 150%, excluding dividends. And the local top 40 ETF, just 36%, admittedly also excluding dividends. Now, as fun as it is to focus on local stocks, it is clearly very important to any wealth creation journey to just lift our heads and look at global opportunities as well. So, with that in mind, a focus on Walmart as a great example of a global retailer sounds fun. Walmart hosted its first quarter 2025 earnings call just a couple of weeks ago, so the numbers are as fresh as some of the produce. It's interesting to note them pointing out that, and I quote, "These are not inflation-driven results, a clear indication that there is momentum in volumes." In the latest quarter, Walmart managed sales growth of 5.7%. Across their product mix, inflation only came in at 0.4%, and here's the really interesting thing. There was mid-single-digit deflation, you heard that correctly, deflation, in general merchandise, and low single-digit inflation in food and consumables, which is why overall inflation came out relatively flat. Now, when prices start to look more manageable, consumers can put more in their trolleys. Of course, if they can afford too much, then we get back to demand-driven inflation, and the cycle repeats itself. Inflation comes through, prices move higher, volumes go under pressure. Now, we've seen a strong response from consumer-facing businesses in the US who have needed to innovate to keep driving demand among consumers who are under pressure. We've seen this at quick-service restaurant businesses like McDonald's, and it's certainly the case at Walmart as well. They have just introduced a new private label food business called Better Goods, with 70% of their items priced at under $5. If you are planning some travel to the US soon with some randellas in your pockets, it might be worth getting some stuff at Walmart based on those prices. Inventory has been a major pressure point for global retailers, especially in the period after the pandemic when everyone was suddenly horribly overstocked and dealing with consumers who were buckling under higher interest rates. When you read the results of global retailers, you'll almost always see a detailed reference to inventory trends and the quality of inventory on the shelves. If it's too old or the assortment is wrong, then the retailer is at risk of nasty markdowns and pressure on gross margin to try and clear it out and unlock working capital. But if the inventory is nice and fresh, then gross margins should be okay, and hopefully working capital won't come under strain either, because the retailer is then operating under a normal inventory cycle. Now, obviously for food retailers, this isn't really an issue because the old inventory gets thrown away as waste, but it's a major focus area for retailers of clothing and general merchandise. Walmart's inventory was down 2.7% year on year, despite their growth in sales. So they have reported a solid improvement in inventory ratios, and obviously the market really likes that, which is part of why the share price performance looks good this year. Another interesting element of the Walmart business model is marketplace sellers. As Amazon grew and started eating the lunch of traditional competitors, those competitors fought back by introducing operations that look more like Amazon. Walmart experienced 36% growth in the number of marketplace sellers and has a SKU or stock keeping units count of more than 420 million different items for sale on the platform. This operation works well in emerging markets as well, with 50% more marketplace sellers in Mexico than the year before. I must also point out the 24% growth in global advertising, with more than 50% growth from marketplace sellers. The lines between platforms and traditional business models on the global stage, and especially the US, continue to be blurred. And to give you some idea of just how vast this operation is and how much organization sits behind it, Walmart is on track to remodel more than 900 stores this year. They actively manage the store footprint all the time, and they also aren't shy to make changes, like the decision to close the US healthcare clinics. As a final comment on Walmart, the return to office trend is playing out strongly at the company. I saw a great article on CNBC this week about how Bentonville, Arkansas is growing rapidly, and that's all thanks to Walmart and its head office being there. A particularly fun statistic is that the town has more cranes per capita than in any other US city, obviously a reference to the amount of building going on, with home prices on the rise as Walmart grows and invests in exciting new headquarters. It's little wonder that Walmart wants its people there in the office, because let's face it, it also creates more reliance on the company if there is shared prosperity, and this of course encourages retention of staff. It's almost like those old mining towns. With adjusted earnings per share of 60 cents per share for this quarter versus guidance of 49 to 52 cents per share, Walmart is looking strong again, and the market appreciates this. If we look ahead to the second quarter and we combine it with the first quarter, they expect first half sales to be up 5% and operating income up by 8%. It certainly makes sense why the share price has had such a great year and why there is momentum in this area in the US market. But as for the local market, it's still quite tough out there for retailers, and hopefully the second half of the year will see some improvement if load shedding can just stay away, and of course especially if interest rates start coming down here. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.